Hello and welcome to Money's Best Friend with me, Vivek Law. Markets continue to be volatile for the last few weeks, making investors worried about their money. Over the past 4 weeks now, we've been discussing how to manage volatility in the current market situation and how to invest correctly. Today in this edition of Money's Best Friend, we tell you what are the right options for an investor. Investors have been nervous about the recent market volatility. FIIs are selling and the domestic institutions are buying. Global factors remain a concern. Let's try and understand why the markets are volatile and how should you invest in volatile markets.
Stock markets have been on a roller coaster ride. BSE Sensex plunged 6% or more than 1600 points on one single day. Equity schemes too recorded an average 6.4% fall in a single trading session. In such a scenario, investors are worried whether to exit or continue with their investments. Here are a few tips for you on how to reap the greatest rewards from the stock markets. Investment strategy. You first need to decide how long you can invest the money for. If it is for weeks, stay away from the stock markets. For short term, park your money in liquid funds or fixed deposits. Invest in equity markets to meet your long-term goals. Continue with your SIP. Invest in mutual funds through systematic investment plans. It helps people save a fixed sum at regular intervals without getting into the business of timing the market. The best part of investing in SIP is you get more units when markets are down and less when they're up, averaging out the cost over the long term. Stagger your investments. Systematic withdrawal plans work better when a person invests a large sum of money in stock markets. You can invest in a debt or equity fund of a mutual fund scheme and opt for SWP facility for regular income. Investors decide both quantum and frequency of payouts. Diversify your portfolio. Do not invest all your money in just one basket. Invest across different asset classes such as equity, gold, real estate to balance your portfolio. Fresh allocations to equity should be made in a staggered manner to large caps as they will be the first ones to gain once the market revives compared with mid and small caps. Rebalance your portfolio. Other than choosing the right product, periodic review of the portfolio performance is also necessary. None of the asset classes have moved either up or down in tandem. Hence, you can better manage your losses if the portfolio is widely spread across various asset classes. And finally, remember what legendary investor Warren Buffett had to say: be fearful when others are greedy and greedy when others are fearful. Tina Jain Kaushal, Business Desk, India Today.
To discuss more on what should an investor do in this current situation, joining me now, Sandeep Sikka, CEO at Reliance Asset Management. He's also the chairman of Amphi. Thank you very much, Sandeep, for joining me here on Money's Best Friend. My first question to you: how nervous are investors? Are you continuing to see investors putting in money into their SIPs? Are you getting new investors? Are the existing investors continuing? What's the data pointing out to you at a more industry level, if you could share that with us first?
So Vivek, I think you're right. I think there has been volatility for the last 4 weeks. But at the same time, we have seen over the last 15 years, investors have been making good returns through mutual fund and through systematic investment plans. We have seen many times investors get a little jittery whenever there's volatility like this. But in long term, we have seen, so if I was to give you share some data with you, since the year 2000, in the last 15 years, there have been 35 occasions when the market has fallen more than 5% in a day. There have been 15 occasions when the market have fallen more than 10% in a month. But in spite of that, we have seen Sensex moving from 5,000 to 26,000. So I think we have clearly seen investors are maturing, and what is happening is, I think the industry data also shows we have new investors who are coming in. We are seeing new SIPs getting registered. We are seeing new SIPs coming from very small cities and towns. So it's a very positive sign, and this is all the backdrop of, because we have seen investors making good return. So the investors who did not get worried about the volatility in the last 15 years have actually ended up making very good returns. So I think our advice to investors will be, volatility at times is your friend. You get scared many times seeing volatility, but it offers an opportunity to the fund manager to keep investing in good stocks.
Sandeep, thanks to the effort of the entire industry, which has been doing a lot of work in educating investors, we've seen more and more people getting interested in either having already invested through SIPs or wanting to know what these are all about and how do they work. Can you take our viewers through how an SIP works and how convenient or easy it is, and also the power of compounding with some data points of the kind that you just gave?
Perfect. So Vivek, it's very interesting. I think systematic investment plan is the easiest thing or the easiest way to create wealth. So let me give you first for the viewers to make them understand. They've all been used to the concept of RD, recurring deposits, in which a small amount which moves out of their bank account goes into a fixed deposit and which happens month on month. It's exactly similar to that. In a systematic investment plan, a certain amount moves out of your bank account, moves into mutual funds in the predefined schemes, and what happens with that is over a longer period of time you're trying to create a corpus. So to just give a number, if somebody had invested 10,000 rupees a month in last 15 years, so effectively he was investing 1,20,000 rupees per year. He has invested effectively in a 15-year period 18 lakh rupees. In spite of all the volatility that we talked about, this 18 lakh rupees has become 55 lakh rupees. So 10,000 rupees a month, or so effectively saying the corpus has increased. He's got a return in excess of almost 20%. And the beauty is it's a small money which is investing every month. And the advantage of systematic investment plan is it's get discipline in your way of investing, and B, also it takes away the human bias of when to invest. Because going to your earlier question where you mentioned about the volatility, see, we have seen in past, investors get worried. When the markets are going up, they think that's the time to invest, or when the markets are falling, they think that's the time to withdraw. But actually it's the opposite. So when the human bias is taken away and the discipline of investing is there, that's the only time long-term wealth can be created. Now, how do you start an SIP? Now, it's a very simple thing. All you need to do is reach out to a mutual fund company, go to their website, go to any financial advisor. All it requires is a PAN card. All it requires is a KYC and a bank account. That's it. And that's the easiest and the smartest way to start making money.
Do you believe that there is scope for further making the procedure simpler and less cumbersome? Because one of the complaints which a lot of investors are making increasingly is that there's just so much of documentation that it seems to put them off. I'm asking you this question more as in your capacity also as being the AMFI chairman. Is this an issue which you are actively engaging with the regulator? And perhaps this is the right time to fix it, isn't it? Because there are investors who, despite all the volatility we've seen in the last 1 month, as you mentioned, continue to want to invest in the markets.
Yes, Vivek. I think we have always been conscious of any feedback coming back from investors, and we are trying to see how we can make it more simpler. At industry level, we have created this platform called MF Utility, in which the investor can invest just through a single check in 5 different mutual funds. Also, what is happening is, I think we are closely working with the regulator to make things more simpler. We're trying to work on eKYC, and this is a continuous process, and I think while the process is not as complicated as it sounds, but I think there is further scope for us to improve it. I think we will be trying, we'll come back very soon with few more initiatives which will make the onboarding of investors in the mutual fund industry and SIPs even more smoother.
There are some questions that have come in for you from our viewers as well, Sandeep. Let's take the first one. This comes in from Kamal Kumar, who's 28 years old, and he's from Nainital. Yes, Kamal, how are you?
I'm fine, sir. How are you, sir?
I'm good. Tell me, what have you done so far with your money? What do you want to know from us today?
Sir, actually, I have not done anything. I don't know how to save money. Just I want to ask that, sir. My monthly income is around 22,000, sir. And I'm not taking any type of insurance policy or FD or anything because I don't know how to save money or how to invest it.
So what do you do with your money? You go and spend it?
Most of the time, sir, I spend it, but I don't have that data where I spend it. I can't tell anyone where I spend it, sir, because I have no savings, sir.
I'm so glad that you've called us. This is the right time. You're only 28, but I think you really need to at least know where you're spending your money. So maybe a good way to do it is that every day just start taking a note. Just write on a notepad, where all have you spent your money? That may be as far as your spending is concerned, but Sandeep is going to tell you where you should invest and how you should invest. Sandeep, it's very encouraging to see young people at least beginning to understand and talk about their savings and investment. This is something which used to happen much later in terms of age. So it's good to see young people getting interested about their money. He is someone who's earning 22,000 a month. He lives in Nainital, doesn't know where he's spending his money, and that's probably because the discipline of investing hasn't really happened in his life. He's not making that forced monthly payment. And that could be one of the other reasons why an SIP becomes so important, isn't it?
Correct. I think firstly I compliment Kamal. I think for the fact that he started thinking of saving for long term. We used to see earlier, normally at this age people used to only be concerned about spending. But this is a very positive trend which has started where youngsters have started thinking about saving and investing for long term. So I think my advice to Kamal will be as following. I think at this young age, I think for him there are going to be 3 or 4 big goals in his life. First is going to be his marriage, kids education. Then is going to be just taking care of some corpus for later in age, for health. And then is going to be taking care of the retirement. The fact that at the age of 28 he started, so effectively if I was to see he has to retire at the age of 60, he's got good 32 years. For him to plan. One of the biggest advantage for long-term investing is to have the age on your side. And I clearly see that I think there is a need for Kamal to start investing for long-term in systematic investment plans. So what will happen is as his monthly salary comes, what he'll be doing is every month a small amount from his bank account will start moving into capital markets through mutual funds, and every year whenever he gets his increments, when he gets his bonus, I think he should keep topping it up. Also what he should do is, he should try to diversify in 3 or 4 mutual fund schemes. Do not over diversify. Try to identify schemes which have a long-term track record of 10 or 15 years. And why I say 10 or 15 years? Because these are the schemes which have shown that I think even when there is a volatility in the market or times are not good, they've shown that how they can bounce back. So identify the top 3 or 4 schemes, look at schemes which have a track record of 10 to 15 years, start investing monthly and keep topping it up regularly. And don't try to over-analyze your portfolio. You should analyze your portfolio every 2-3 years because many times there's a temptation to see what is happening. When the markets go up, it's very good to get this feeling my portfolio has gone up, or get worried when the markets tank. But ultimately you're saving for next 30 years. So what happens in 1 day or 1 week or 1 month will not impact your 30-year planning.
All right, Sandeep, we'll leave it there. Thank you very much for coming by and sharing your perspective with our viewers in these interesting times of investing. Thank you very much once again.
Thank you. Thank you, Vivek.
Suresh Sadagopan, founder Ladder 7 Financial Advisories and one of India's best-known certified financial planners, now joins us to discuss more about how to manage your portfolio in these markets. Suresh, what are you telling your clients? I know that things are not as bad. We've not seen those 1600 odd point sharp cut on a day anymore, and there is some sense of stability coming in, but clearly we still live in volatile times. What are you telling your clients right now?
Most of my clients are not actually worried because they have been with us for a fairly long period of time. So they have seen the worst periods like 2008, 2009 and those kind of periods. So they are not really that very worried. What I'm trying to tell them is we have to stay the course. There is nothing dramatically wrong with the Indian economy. As a matter of fact, among the emerging markets, India is probably one of the brightest spots. A lot of the problems are emanating from abroad. So be it the China problem, be it maybe the scare regarding the US increasing the interest rates, the problem in the Middle East, the problem in the Eurozone. So there are a lot of problems which are there, which are kind of impacting our markets, and a lot of FII money has flown out. Unfortunately or fortunately, FIs control the Indian stock market. Retail participation or the domestic investor participation is comparatively muted, especially in terms of day-to-day participation. FII participation is very high. So what we are telling them is India in the next 3 to 5 years is actually a very bright spot, and we have an opportunity to grow by anywhere like say 7 to 8% in the foreseeable future. So what we have been telling our clients is that stay the course. You have seen bad times, you have seen much worse times than what we are seeing today. There is a bit of volatility. There can be more volatility because if the US starts increasing the rate, there can be a bit more volatility before it stabilizes. So we are simply saying stay the course, stay invested.
All right, Suresh, some questions coming in as well for you from our viewers. Let's go across to Rajaram. He is from Mumbai. He is 56 years old. Hi, Mr. Rajaram. How are you?
Yeah, I'm fine, thank you.
You are going to be taking a voluntary retirement and getting a big corpus, and you want to know what you can do with it.
That's right, that is right. Because there is no immediate liability. And then that sense, it's been a lucky period. And then I can pick and choose what I want to do next, so I don't need to then desperately look for a job. So this is a sort of
You wrote to us, Mr. Rajaram, that you want the best and the safest investment strategy. Do I therefore presume that you have very little appetite for risk?
Yes, I want to keep this as a safety net, so that then I can choose and pick and choose what I want to do in the future.
Yeah. Okay, Suresh, he clearly wants to know what he can do. He does not seem to have much of a liability anymore. He's taken care of that part of his life. But he did use the word safest. What would you like to advise him?
Yeah, Mr. Rajaram is at 56. Obviously, he will want to be safe with his investment, especially when he is taking the VRS. Yeah, he has also told us that he is going to work for some more time. How much time is not known. About 35 lakh corpus is going to come in. As far as I can understand, there are no immediate requirements for money. So one of the things which he wants is safety. So from a safety perspective, there are probably two instruments which we can look at immediately from a tax efficient perspective. One is of course the tax-free bonds, which are expected to start coming in any time now. There is some 40,000 crores of tax-free bonds which are expected to come in hit in the next few months. So he can expect on an average about 7.5% return. The good thing as far as tax-free bonds is concerned is that he can lock in that return for the next 10, 15, 20 years. So irrespective of the interest rates moving down, he can expect a stable return over a long period of time. That is one of the investments he could consider. The second is investing in debt instruments. Debt instruments in the sense I was talking about debt mutual funds. So one can invest in a debt mutual fund with a say medium to long term duration, and they can initiate a systematic withdrawal plan from after investing in a debt mutual fund. Our calculations show that even accounting for the short-term capital gain tax and even accounting for the exit loads, on an average you pay something like say 3 to 4% as tax, so which is not really much, and the income can be set up from day one. So that is the attraction. And one more thing Mr. Rajaram wanted to know was how to, does he have to open a demat account? So a demat account will be required as far as the tax-free bond is concerned. So that will also enable him to trade at a future point in time if at all he does not want that money, and he wants to take advantage of the capital appreciation which is expected to happen in future. So that is what I would advise for Mr. Rajaram.
All right, Suresh, there's also an SMS that has come in for you. This is from Zaka Sharif. He is from Kerala. His question is that he wants to invest 10,000 rupees every month in a mutual fund for a period of 10 years. Please suggest what are the options and how to select a good scheme. This is an excellent question, isn't it, Suresh? For one, that here is a young person talking about a 10-year investment. And the other one is a very relevant question even for all our viewers. How do you really go about choosing a good mutual fund scheme?
It's a good thing that he is talking about a 10-year horizon, which is actually fairly long term. See, now how to choose a mutual fund for your particular situation is something, there is a bit of analysis. You cannot really go by the 4 stars and 5 stars and choose a mutual fund. So a lot of things actually depend on when are your goals, what are your kind of goals, what is your risk appetite, and what kind of return will you be happy in terms of expecting from the investment. So there are these things which we will have to consider. So for example, suppose somebody wants the money back in a matter of say maybe 1 to 2 years, then probably equity is not probably the correct investment. But in his case, he is talking about a 10-year horizon. So I presume that he is actually looking at it from the long-term point of view. So now, based on the risk appetite, based on his age, one can look at, start looking at large caps. It can be mid caps, it can be international funds, it can be a whole range of things. But if a person is not really aware about the mutual funds and how to put together a portfolio, I would ideally suggest that he should approach a proper advisor. A mutual fund distributor can himself actually help in putting together a proper portfolio based on his risk appetite, based on his goals.
All right, Suresh, thank you very much for joining us here on Money's Best Friend. Appreciate you coming by and taking our viewers' questions. All right, it's time now to wrap up this edition of Money's Best Friend. We do hope you've got some answers on what you should do in this current market situation. If you have any query related to equity, mutual funds, insurance, real estate, gold, then do write in to us at moneysbestfriend@aajtak.com. Goodbye and have a nice weekend.